get things started here in just a few minutes. I'm going to keep letting people in as we go. We are going to, everyone should be muted. If you're not muted, please mute yourself during the panel. So, and then we are going to do some breakout sessions at the end so you guys can meet some of the other attendees if you want to stick around for that as well. We'll give it another like few minutes here just in case people are running a little bit late. If you guys haven't been to one of our events before, or if you haven't been to one of our virtual events before, my name is Michael. I'm the CEO of Entre. We're a social network for entrepreneurs in the future of work. So we're really just trying to connect all of you guys together, people not only in the real estate industry, but technology, pretty much every industry there is, and figuring out ways to help you start your businesses easier and faster. We have rolled out our app, which we've been building for a while now. So that is exciting. I'm going to be dropping some links in here too. If you guys want in the chat to introduce yourselves to everyone as you come in, feel free to drop, your email, your LinkedIn, whatever, where you're coming in from, where you're, right now. I don't even know if people are still isolated right now. If you're not where you usually are, just let people know where you're from, where you do business, what your business is, all of that. And yeah, I'm super pumped for this. I mean, I have a deep passion for real estate. That's like what got me into entrepreneurship from the beginning. So I'm super thrilled about this. We have a fantastic panel. I mean, these guys are amazing. And I'm thrilled to hear what they all have to say. And we have Charlie Stevens running the show, which, there's no one better out there than him at doing that. So I'm excited for this. If you guys want, okay, I see Andrew dropping some stuff in the chat. Fantastic. Okay, Scott is here. Great. Wonderful. I'm going to throw my stuff in here too, guys, if you guys want to contact me or anything. If you guys want to jump into the app, I know there are some people in here that I've seen that I recognize that are in the app as well. But we got some great stuff going on. There's a lot of cool entrepreneurs in there already, people, investors, all of that, just networking in a like-minded place. So I just dropped the link there for that. And okay, we have some more people coming in. Let me let these people in. Okay, and then let me pass it over to Charlie. I think that's all I want to talk about with Entre. We have some cool events coming up. Charlie's going to be doing some cool interviews with some CEOs and investors too. Charlie, you want to quickly introduce yourself, and then we can start introducing the panelists as some more people come in here, and then we'll get the panel kicked off.
Cool. Thanks, Mike. Appreciate your time. Appreciate everyone coming in here. We have a great panel today. Just to introduce myself, Charlie Stevens. I work with Cushman & Wakefield. I'm an office leasing advisor. So I help companies grow office space in New York City and growing startups. I've been focusing on tech startups, major corporations, and everything in between. So I bring that little bit of background with the commercial real estate aspect from Cushman & Wakefield. We have a great panel from VC commercial real estate investor Andrew Ackerman, the head of UrbanTech Dreamit Ventures. We got an investor with Philip Michael, world famous. The guy's crushing it all over social media too. If you haven't followed him, get on top of that, doing big things. And Drew, CEO of Lex. So as we do all this, I definitely encourage Q&A portion. Submit your questions. I'm going to miss some questions. We're going to try to be as free-flowing as possible, but we're going to talk about the future of real estate. And there's a lot of different topics and a lot of different aspects of things going on right now. So definitely chime in and let's communicate with each other to try to get this to become the best conversation possible. So let's just start off with a little bit of a roll call. Andrew, if you want to start off, and then we'll go to Drew and Michael. Phil, sorry.
Sorry, works better when I'm off mute. Thanks, Charlie. So I'm the managing director of Dreamit UrbanTech. So Dreamit's a fund. We invest in 3 verticals. Health tech, totally relevant to this conversation. Secure tech, sometimes relevant, but mostly urban tech, which is, in my book, prop tech or real estate tech, and also construction tech.
Highland Beach?
I have no idea what that question was, but I'm happy to take questions later. I think now is
Lola is not on
Yeah,
on mute.
I just muted her, so we should be good. Yeah, if you guys are coming, everyone who's coming in should be on mute. If you're not, make sure you are, just so we don't have any interruptions. Thank you.
Drew?
Yes, no, thank you guys for having me. I'm Drew Sterrett.
Sorry.
I'm the CEO of Lex. What we've created is the first commercial real estate securities market to actually open up investing in institutional commercial real estate assets to everyone and have a liquid and accessible market. So just changing the way that we invest and provide another capital tool to commercial real estate owners across the board.
Yeah, very cool website. Check that out. Phil?
Yes, you call me?
Yes, yes, sir.
All right, so Michael, I'm the CEO of Nice, and what we're doing at our core, we're a real estate development firm with AI and smart tech powered real estate developments in Philadelphia and New York City Metro. One of the projects we're doing the first Black-owned high-rise in Jersey City. We're doing a smart tech development by Temple University, and one of the first, if not one of the first by now, smart tech buildings in Jersey City. But what we really are to our core, we are wealth creating, a wealth universe, if you will, a wealth community of now bringing in micro investors to own part of this with us in order to help wipe out some of the wealth disparity that exists in this country. So we're helping people build a foundation of their wealth by coming into our community. One of the ways we do that is obviously giving them access to our portfolio, but also through an app that's coming out in Q3 that's similar to Robinhood, and that will allow us to scale down the road because we're not just going to do our own projects. We're going to do OPP, other people's projects in there as a GP. So, but that's a totally different conversation. At our core, we're a real estate developer that has tech-enabled functions. So we try to be very current, very modern. But the overall mission is to create a larger portfolio with access to all. So that's us.
Yeah, super exciting. Let's start off before we talk about the future of real estate. I think we have to talk about the current market, the state of the market, what's going on right now. As a commercial real estate broker for Cushman & Wakefield, personally, every deal that I've been working on with somebody who's looking for office space has put it on hold. If they're looking for 2 floors, maybe they're only going to commit to 1 floor. Every 10-year deal is turned into a 5-year deal. 5-year deal is turned into 12 months. Everything's basically on hold because no one knows what's going on. You have the pandemic, protesting, systemic injustice. There's just a lot going on right now. And I want to hear from all of you, and I guess we could start with Phil, kind of work backwards again, how this is impacting your business and what do you see in the real estate world and how you kind of, what's happening with everything right now.
I'll try and make this as concise as I absolutely can, although it's a very, it's an excellent question. It has some degree of complexities to it. Number one, real estate as a whole industry has been affected by COVID. Obviously, there's some, as you know, Charlie, as you just mentioned with office, the number one's asset classes within real estate that have been hurt like crazy is, of course, retail, hospitality, hotels, and office. And I think you're going to see, I think you're going to see the impact isn't felt right now is going to be when these landlords eventually have to foreclose. So I think you're going to see a second wave, if you will, economically of people being hurt 12 to 18 months from now when the foreclosures really start to hit. So that's on one end. And of course, on the residential side, those who had existing tenants are going to be hurt also because tenants, from what I understand, don't have to pay for the next 12 months, whereas the banks only give you 90 days of sort of a leash. Now, what has this done to us? Because we're developing and we have 4 active complexes that we're developing, they don't actually have tenants right now. So by the time that all this is over, we will be delivering products to market. Our AI complex by Tempo is halfway done. By the time that it gets ready to go to market, things should be back to normal. So that's so what this has done for us is create a lot of opportunity from the standpoint of deals that we were trying to chase last year, particularly around Philadelphia, because again, real estate is a stable asset class. So anybody that's conservative money would want to go into a core stable asset class like that. And now when there's uncertainty, that's when people want to get out. So at least this is what I've seen for me personally. It could be different for other people. Again, there's submarkets and asset classes that differ. Now for us, it created a lot of opportunities. We have new projects we're bidding on. We have another one that our group has put another one on contract. So it's really, selfishly, it's exciting from that standpoint for us because again, we've built everything all equity. So we're very well positioned to take advantage of that. So for us, it's been a boom. But we're also in one of the asset classes, or one of the business models that can never be disrupted, which is shelter. So for us, it's been as horrible as it sounds on the macro level, but it's been wonderful for us.
Sure. Drew, how about yourself? I mean, you have people trading investments in real assets right now. I mean, what are you seeing in the market?
So it's really interesting. I sort of share Phil's sentiment, where it actually provides a whole bunch of opportunities, since you have even the most institutional investors who have now taken a 180, where credit has dried up. There's a whole bunch of uncertainty, and there is going to be a lag. I mean, real estate lags in general, just as an industry. And so even though like office rents in Manhattan have still come in at between 85 and 90%, retail has been hit much harder. And so most real estate owners are reevaluating, and they're still not quite sure where this is all going to end up. And also it's going to affect not only pricing of assets, but also the leasing of space. Where is multifamily going to be? And so even new developments are sort of being questioned, where it's like they underwrote certain pro forma numbers, and is that going to be the same in 12 months? And it's actually forced them to be a lot more open to new innovations and new ways of viewing their portfolios and how they play both offense and defense. So business has been good, except I would trade it for not having COVID happen in the first place.
I think so. Moving on to Andrew, I mean, you're investing more so in the technology companies that have to do with real estate, and Phil and Drew kind of broke down the current market. So what are you seeing on the investment side with these real estate companies?
Yeah, sure. I was going to say, like, when it comes to the market outlook, I usually ask you, Charlie, right?
Sure.
I'll ask the other guys that, the other companies in our customer network that we use to introduce to our startups. And I'm hearing basically the same thing. As far as my world, like, in the venture world, you've got committed capital. Like our investors, our LPs, have to make capital calls. So short of the world collapsing, them actually defaulting on those obligations, we have money to invest. And what we've learned in past cycles is when the market is, down for startups, it's actually a really good time to be in venture. A lot of the strategic money, a lot of the dumb money is now on the sidelines. Like, I don't see a lot of large real estate families who are dabbling in startups suddenly investing in startups now. They're all worried about, what's going to happen, who's going to make rent next month. So that money dries up, which means valuations become a little more favorable to us. It also means that the startups that we invest in will, on the margin, face less competition, because those other companies are like, maybe could make it, maybe couldn't make it. They're not going to make it when money's tighter. So what we found, this is going back all the way to 2008, 2009, some of our best investments come at times like this, which is a really long-winded way of saying, yes, we have money and we're investing.
Well, let's stick with you, Andrew. I mean, you were talking about possible recession coming up, recovery time, and how you're taking advantage of it. I mean, what have you seen in the past, and like I know you don't have a crystal ball, but if you were to kind of, with Cushman & Wakefield, we're talking about possibly 12 months to 18 months of some sort of dip in recovery time. CBRE, our number one competition, is predicting a little bit less, probably 12 to 14 months or something like that. But I mean, what are you seeing with recovery time, not so much in the real estate market, but in the general, aspect of the economy?
So I live in this weird sort of bubble with none of my investments are actually expected to be profitable. So like, they're not going to be profitable now. The difference really is, are they going to survive and make it to the next milestone? So I think about the world in a kind of, sorry, I caught myself. I'm not sure if this is an F-bomb friendly show. I'm in a kind of screwed up world, right? So what that means is that when I talk to the startups, I really ask them to consider the world through three lenses. It's like, number one, they need to know this new normal, whether it's 12 months or 18 months out there, is that better, worse, or about the same for their startup? And for many of them, since they're on the cutting edge of a lot of trends, their biggest challenge has been to find the customers who are more willing to embrace rather than fight these trends. And in some areas, like COVID's obliterated the resistance, like distance work, distance learning, telemedicine. All the customers were like, I'm not sure if we can make that work. We're going to sit that out. Like, that's done. They're doing it. So the future for those companies is really rosy. For many of the startups we're in, it's about the same. It'll go back. It's kind of a wash. We're not in any asset-heavy industries like co-working or co-living. So there's nothing in our portfolio really where like the long term is bleaker than it was. So number one, I ask them like, what's the long term going to be like? Number two, I ask them, how do you make it to that long term? And as a rule of thumb, I'm saying you need 12 months of runway. All right, whatever your revenues are, slashed. Whatever your costs are, as low as you can bring them, like, can you get to 12 months? And sometimes that means raising an inside round to get there. And that's where, you were asking me about, like, what am I seeing? 12 months plus or minus. Different parts of the country, different industries will vary. On the construction tech side, for instance, there's not a lot of impact. It's an essential services. In some cases, they're selling faster than ever because a lot of their product makes the job more efficient, lets you do it remotely. In prop tech, again, it depends on who you're dealing with, and what part of the country you're selling to primarily. But I use 12 months as a good rule of thumb. And just to wrap it off, the third thing I talk to my startups about is, in this environment, is there a way to make lemonade out of lemons? Meaning, is there something about your product or service that's suddenly more relevant and more saleable than it was before? But we can get into that a little later because I don't like talking for 5 minutes straight. I want to share the air.
Let's go over to Phil, because Phil is investing in these properties, and Phil, Andrew just talked about, the construction side of it is not being affected as much, and you're a part of that construction side of it as well.
Yeah, absolutely.
So talk about the, possible recession, the dip and recovery time that you're seeing, in that opportunity gap, I guess, where you could try to jump in.
Okay, so one of the things that we've seen that's actually been, if there are other developers, they could actually be in a tough spot, is that nobody's really doing construction loans. People just sort of jumped from wanting to put money in there to just sort of jumping on the sidelines. Because again, if you're a construction lender, your bet is that they put a permanent mortgage on it and pay you back plus the bank, and right now there's so much uncertainty. So they're just sitting there waiting. Now, again, we bring capital from Denmark where there's negative interest rates. So we're better positioned to sort of handle that. And on top of that, it's, that we have a different type of access to capital. But in terms of how the construction will work, and we were down for a little bit, then it became a thing where we had to have less people on site working. We couldn't have 10 people, so it was 4 or 5. So things were moving a little slower. Then we had a few weeks where we couldn't do anything. Then it came back to we could have a few people. Now it's just ramping up and just going, it's just moving forward. There was just ways to just figure out how to get around those limitations. So from that standpoint, it slowed a little bit, but not anything that was that slowed us down in terms of when we were going to deliver these units to the market. But in terms of the lending and actually capitalizing these things, that has been difficult for a lot of people, from what I've heard, because that capital is sitting on the sideline. I actually find it interesting what Andrew said, that the LPs have to meet their capital calls. And I'm kind of curious about that, Andrew, if you don't mind me asking, is this not a circumstance where, because in every contract, I forget what the actual legal term is, but what it say, basically the world going under clause, is that not something they can point to?
No, it's not a venture thing. So in venture, I can tell you this offline, or Charlie, you tell me if this is way off topic, but the short version is no, we're not tied to any one particular investment, so there's no act of God clause. We're in for like a 10-year plus cycle, and that's over and over. So no, there's no can I have a do-over option in VC.
Right, because in the real estate space, that people can even deals with people have had in New York, a lot of people they had deals under contract, and they use this as an out why they could back out of a certain deal, because they may not have the financing, the bankers back out. If they back out, you have to back out too, because you can't close the deal. So, but from that standpoint,
I live in a weird world. I mean, I meant it from the beginning. It's different.
Yes, absolutely. So it's created from that standpoint of construction. I don't know if you can say that has created any opportunity at all, because it's really slowed down. Yeah. And the capital that will bankroll the construction has sort of set aside. But what that really does is it just creates that surplus of opportunities where people say, you know what, let me liquidate and go elsewhere. Yeah. And then there's the reptile.
You're absolutely right, by the way. Like, there's a big difference between projects already underway and ones that weren't funded. The ones that are underway are ahead of schedule in a lot of ways.
Yes. So, yes, those are my thoughts, Charlie.
No, it's good. It's all good. And I think you're talking about an act of force majeure, act of God. But Drew, going over to you, I mean, what are you seeing in possible recession? If I'm investing in a particular property and I have some cash, maybe I want to start putting it into Lex and investing into actual physical space. But I mean, what are you seeing from your, customers and the market?
So there's actually been a large push, both actually on the retail and then also on the private banking and institutional side, where they're looking for direct access to individual deals, which they usually do not have access to. So we've sort of seen the client base actually pushing sort of major financial institutions in the right direction. I know we saw a whole bunch of, when this was initially happening, we saw people trying to spin up hospitality debt funds, since they were like, oh, we're going to have hundreds of hotels going under so we can get them for pennies on the dollar. But I think that was not, I think it was misguided for the most part. Yes, there will be opportunities, but the opportunities that are going to be available, we won't see them really for 3 to 6 to 9 to 12 to 18 months. And so it's a much longer process. You have to remember, it really takes, unless it's an immediate transaction, all cash, in an extreme circumstance, the deals still take 3 to 4 months to close. So I still think we have a lot more coming. And really, when you're going into an investment, you really have to look at the tenant base, how long the leases are, what the credit ratings are, and sort of what the macro economy is in those different locations. Since I think New York specifically is also impacted differently than the Southeast and also other areas. So it really is a case-by-case basis.
How about the future of real estate investing, right? And I guess we could stick with you, Drew. I mean, do you see a change in the process and the deal flow and what you're kind of looking at, and the, you know, the check marks you have to kind of go through to make the actual investment?
Yeah. So, I mean, our main goal was to make it so you don't have to be the 0.01%, where you have to put in multi-million-dollar slugs into individual assets, really through 2 methods if it's direct real estate investing. One is through direct syndication, and the other is private equity funds. Yes, you do have public and private REITs. Private REITs also do have certain thresholds that you also have to meet, but there will be a lot more direct access to the entire financial sort of spectrum, and give people more choice and the ability to actually sort of, as Phil was saying, create wealth for themselves. And it's not just for a select group of individuals, and at the same time have infinitely more transparency in data, and open up an industry that has been known to be very slow, sometimes ripe with fraud and some bad actors, and those will be weeded out.
Phil, you got called out. Why don't we move over to you? We're talking about, you know, changing the investment process and the deal flow. What are you seeing?
What do I see? I mean, I think the way the systems will work, I think it will pretty much remain the same, because the ones who dominate the deal flow is the strong capital. For instance, Blackstone, and throughout, and I know this from reading the founder's book, that he always keeps himself well positioned. And obviously, they have $570 billion in assets under management, but keep himself well positioned to weather any storm. So, and you'll see a lot of the large private equity funds and the large endowments still control the majority of the deal flow. And so I see that sort of remaining a stable, a constant for the foreseeable future. However, something, just to throw it out there, like a Fundrise or Realty Mogul, something where micro investors, when I say micro, basically anything that's less than 10K, or anything that's what a credit, which is a small accredited investor check, anything really under 100,000, but 10K and below, I think you'll start to see a lot more than that, sort of like how you went into the public equity markets. And we've seen personally a lot of investor interest. I haven't even promoted, and there's been a lot of people that have come in and bought shares. I think you'll see a lot more of that. Obviously, you're not able to scale with micro. You need the large checks to do that. But I think from an investor standpoint, you'll see more people who didn't invest before come and invest. But in terms of the big money that really still moves the needle, I think some of those things will remain the same. I don't really see how a GP-LP model can be disrupted. You saw some realty shares and some of these other crowdfunding platforms that raised a boatload of venture capital, and then they got to the Series A, Series B stage, and Series C even, where they started to run out of money, and the business model that they have and the lack of profitability, the deals didn't mature and show that exit that they needed in order to cover the losses that they've driven, and then they just had to liquidate their portfolios. Right? I mean, you see a number. There's one called Prodigy Network. Realty shares is one example. So they tried to disrupt the fundamental model of how big money makes moves. I don't think that's really going to change. Deal flow, I think, for a lot of below the institutional investors, but above the mom and pop, sort of this large gray area where people like, even like us at this current time operate. There's going to be a lot of deal movement, I see, but the strong money that sort of controls everything is pretty much going to remain constant from my perspective. I mean, but it's just my opinion. So.
Phil, we'll have to talk afterwards since we got some things on the horizon that's going to change that dynamic. So
interesting. I like to see that. All right, great.
Yeah.
Look at that, making things happen already. Andrew, how about investing process for you into real estate companies? I mean, there's got to be a lot of change here.
Shockingly, not so much, right? So, I mean, I think Philip and Drew are covering the time. So remember how I said, like, it's like, is the future better, worse, or about the same? Like, I think whatever tailwinds or headwinds a crowdfunding site for real estate or tokenized ownership of real estate, I don't think those change that much. Whatever trends were either there or not will continue to play out after the immediate kind of choppiness passes. On my end, the investing in the real estate companies, again, it's in the long run, do I believe in what the company's doing, which may have changed given what's going on right now. So that's one of the things we did with all our portfolio companies during the first month when the crisis hit. Number two, can they make it, right? I'm a little bit more hesitant about putting money into a startup that's early on and that, like, they don't have other strong investors at the table. So if things get a little tight, there's no one else to bail them out but me. But those are kind of changes on the margin, right? At the end of the day, if the startup is really disruptive, and it's a tech startup, we're not talking about real estate as an asset, we're talking about real estate technology. If that startup's really onto something, like, I'm making a 10-year plus bet as it is. So it's really just on the margin. My process doesn't change that much.
Okay, let's talk about the actual physical change of real estate. What's happening? I mean, with Cushman & Wakefield, we put out a big report called the 6-foot office space. Essentially, going back to cubicles, larger cubicles, no more bench seating, giving room in between your coworkers. There's going to be a system when you go up the elevator that everybody kind of stays on the corner. And I don't think landlords have quite figured it out already, and we're certainly not in the phase to get back to the office completely. And you're also seeing the shifts of 25% of the employee going back, and then maybe shifts to A squad and a B squad. But regarding the physical changes of layouts and putting together, maybe constructing a building in a certain way or a different way, what physical changes are you seeing? I'll throw this out to the group of whoever wants to jump in.
I'll take a quick stab at it. Well, not so quick because it's a big, juicy topic. So what you're talking about falls under the rubric of return to work, or at least that's the emerging, hashtag for it. And there are a couple of things that either the head of corporate real estate or the head of HR for large companies are thinking about right now. So as we get into phase 2 and phase 3 and people are starting to come back, they got to deal with a couple of different issues. So number one, there's going to be a good chunk of their employee base that don't want to come back. Not because they like working at home, because, God, I'm done working at home. I'm fantasizing about going to Starbucks, right? But it's because they may be older, they may be immunocompromised, they may simply be nervous. They don't want to get on the subway, they don't want to get on Metro Rail. So for these reluctant workers, they need to come up with something. They need, especially if they're actually immunocompromised or older, they need to make a reasonable accommodation. So they're starting to think about, do I put some budget into letting them get a better chair for their office, right? A better teleconference, right? Now, I might actually have to give them money to make them more effective if they're going to be working from home. Or conversely, I can't have them work at home. They can work at a co-working style space that's nearer to them, that's set up appropriately. So they're starting to think about perhaps allocating some budget for that. And that rolls into, you said this really fast, so I'm not sure if everyone heard it, the phased return, right? So if you take a footprint of an office that's designed around a certain density, and now you're saying, aha, it's got to be 6 feet. You need a lot more space in the long run. I know there's some people that are saying that's massively beneficial tailwinds to landlord in the long run. We'll see. But in the short run, if you're a corporate HR officer, you got to figure out, like, how do you get people back into the office and physically make them fit? So phased returns might be certain departments coming back. It might be rotating. Certain groups have the office one week and then the other week, they're working from home and vice versa. Or again, maybe you've got overflow space in corporate, in like co-working. Or some of them are trying to make lemonade from lemons on their own by saying, well, we just had all these other places go bust. Can we repurpose that space and make it our own temporary workspace, co-working space, or overflow? So all of these things are factoring into the discussion when it comes to the tenant saying, what do I do over the next 6 months to a year? Hopefully we get a vaccine and this is all but an unpleasant memory in a year or 2 years. But until then, there's a lot of adjustment, and the people are going to think pretty far outside of the box during those 6, 12, 18 months.
Phil or Drew, jump in here.
I mean, so personally at Lex, we are trying to monitor how other people are doing it. We want to do it the right way and make sure that everyone does feel safe, since it's not just the practicality of making or having everyone come back, but sort of, as you were saying, Charlie, too, is people who are a little older, immunocompromised, just worried about the situation themselves, is to make sure that they feel comfortable coming back to a workspace and that the workspace works for them and their personal needs. So it's actually more, even touches mental health, because you don't want to force them to be in an environment where they feel uncomfortable. And it does sort of push towards the notion of more space in sort of larger layouts, just so you have separation and people can feel comfortable. And I mean, funny enough, I know WeWork was a complete fiasco, but in a different scenario, it could have actually been a great boon for their business model, just because it is flexible workspace. You have the ability to grow out. Just interesting to see how the world plays out, sort of ironic.
If I may interject really quickly, is from the residential standpoint, one of the things that we've seen and is having antivirus. And so really there's been this paradigm shift in terms of how we think of hygiene naturally, because people didn't want to die. And this has led to a shift in the markets of sanitary, like the sanitizers. The prices went up for a little bit. Toilet paper, for no apparent real reason, just the price would go up. And now we have these things where people come in and almost like an exterminator would to kill roaches, like the bombs. There's stuff like that happening. I'm seeing that is approaching me. Look, we can make yours antivirus compliant. I don't even know what that means. But these are some of the things that we'll see, and whether I believe it or not, which I happen to do, it doesn't even really matter, because the end user, the customer, their tenant has to feel safe and feel comfortable. And we have to make sure that people aren't jeopardized from that standpoint, even if it's their tenants and it's up to them how they carry their hygiene and passing germs onto each other. Still, there is some sort of responsibility as a landlord, as a property owner to have things like that. So I think that's something that we're seeing from the residential standpoint. What are some things that could help keep this new increased higher level of hygiene, really? Because I think we're rethinking hygiene in a lot of ways. At first, when the whole thing hit, I thought people that had the mask looked absolutely ridiculous. Now it's just what we're doing. So, and it is becoming fashionable. There's the science. So I think some form of technology or products around antivirus sanitation and this, sanitizing and this stuff like that, I think we'll see more. At least I've seen some indicators of that.
So Phillips really are onto it. Like that third category, lemonade from lemons, is where I'm seeing that happening all the time. So you have access control companies out there, both on the residential and on the commercial side, which are now, stressing they have touchless access, right? You don't have to put a fingerprint, I don't have to do anything, I have to swipe a card or keypads. It was a feature they supported for a long time, but now it's bumped up to number one in their marketing. Or we have another company, this is actually a portfolio company of ours called Cognition. They use video to make sure that the person who just swiped in is who they say they are. So they can connect to any IP-related connected camera. Now, that camera could be a thermal camera. No one's ever asked them for that before. If there's a feature list, that is like below the bottom of the fold for them. Except now, a thermal camera at the front desk, which alerts you if any of the delivery people have elevated body temperature, boom, that went right up. So they've actually taken that ability, taken a small portion of their total functionality, given it away for free during the virus. It's a way they can do good and at the same time get their foot in the door, sorry, no pun intended, with potential sales prospects for later. And I've even seen a company, this is not a Dreamit company, they're a drone company that was originally going out there to do cleanings, right? Windows, walls, exterior cleanings, big heavy tether with like, cleaning spray sprayed against the wall. Like those contracts dried up. No one was paying for that now. Well, smart guys, they pivoted quite literally. They turned the nozzle, pointed it down, put a sanitizing solution, put electrostatic sprayers on it. And now they're selling to stadiums who will need to sanitize these huge areas in a short period of time between games, right? Same drone, different nozzle, different sprayer. Doesn't have to be tethered anymore because it's, it's less liquid per square foot. So we're already seeing a lot of companies either stressing stuff that wasn't important before, moving some stuff up on the dev pipeline in reaction where they can react quickly, or otherwise, just making hay while the sun's shining. I will say that, there are companies that come back to me and they're like, we're going to do a total pivot. We're going to do this. And I tell them, don't bother. There are other startups that are closer to where you want to go. I guarantee you there are a lot of people thinking of it. If you're going to throw out your entire model and try to do something else, you're going to be late to that party. But if you're in an adjacent space like that, you got to figure that out, because this could be a really, really big opportunity for you to both do good and do well.
Let's stick with the technologies and the smart building aspects. I mean, there's a lot of new technologies that are coming out there. I've been doing commercial real estate tours for the past few years, and now it seems like it's, the thing. And there's a company called Matterport where there's hubs where you take the video camera and everybody, you can't show office space now. You need video tours. So that's what I'm seeing, definitely. And there's everything that you just touched on, Andrew. But what other technologies are up front? And I'll throw it over to you, Phil, that maybe that you're looking to put into a building. And I know that you have some experience with smart buildings that you're interested in.
Sure. So one of the things really, if you look at real estate as an asset class, largest in the world, and obviously there are sub-asset classes of real estate, and it is really a simplified way of saying it, but the large landlords haven't had a reason. So any type of business, you have to service your customer, your client. And for large landlords, that's not the tenant, that's the investor. So the tenant is a means to an end to serve them. So that's why you have some of these new technologies not being adopted, because they can't see the immediate return on investment, or they feel as though if it ain't broke, don't fix it. That type of thing. Whereas we haven't had that dynamic, so we can serve the end user. For that reason alone, to answer your question, the technology component that we integrate is basically just centered around the fact that people live off of this here. And what would be convenient for me? For instance, our high-rise project, which is, it's not the largest high-rise, it barely qualifies, it was 100,000 square feet. And right across, there's one with 4 or 5 towers, I forget exactly. And it's a little bit of a walk from the PATH train, which binds Jersey City and Lower Manhattan. They have a shuttle. It's an antiquated way of thinking. They go from that system. What I was thinking is I ran the numbers. Okay, vehicle, insurance, fuel, you got to pay a guy to drive, and it still operates on a schedule. Whereas it would be easier for us we went to cut a deal with Lyft to where our tenants could get free rides. So now you have a personal driver. So we turned that into a positive. So there's a different way of thinking about it. Whereas, where we're not going by how it's used to been done. And what we have right now in terms of the technology, it's really, it's just whatever's on the market, but people haven't really adopted. And I think it will evolve over the next 2, 3, 4, 5, 10 years. New technologies will come in, and we're really just try and stay on top of what the best practice is. In terms of that, it means, okay, Nest is excellent. And you have keyless entry where you can have a key, but you can also use a card, or you can have facial recognition. All these technologies are out there. And one of the things that we're doing that I think is really cool, and I don't know if it's really smart tech per se, is that we have e-scooters in another building to sort of circumnavigate that whole walkability issue and just turn it into something fun and practical that is apropos for the end user that we serve. And we can think about that because we're not serving the LPs, we're serving the end users. And because of what's happened now, I'll make my final point, is that the whole thing why it's been slow to adopt new technology is because people are naturally change resistant. That's just how we're wired. So if there's nothing that stops us from, if there's nothing that really forces us to change, we won't. But now you're seeing, just like this event now, this probably would have never been an idea before. Now we're realizing it can actually work. So, and now it has just forced a lot of change, wiped out the change resistance, and you'll see a lot of new stuff, and I'm just trying to keep up. That's it.
Sure. Drew, why don't you jump in here? I mean, you are a new technology, financial technology for real estate. What are your thoughts on this?
So two parts. One, yes, real estate owners are slow to move, and especially a lot of this technology has been out there for a while, and yes, it continues to get better. The only time that it really surfaces and actually becomes implemented is, well, three situations. One, they really are forward thinking. Two, it's sort of demanded by the client base, so it's a necessity for them to keep their tenants. And then three is it's economically driven. And so in this case, I think everything that was just brought up right now is sort of two and three is now making them also be forward thinking. Sort of two things that we're also seeing in the market where it'll be interesting to see how it develops is also figuring out how to make easier closings and easier real estate transactions where you have a whole bunch of different parties trying to come together, especially in a socially distanced world. How does that come together? How do we have good project management tools to make sure that all of this goes smoothly? And then sort of the second part, which is inherent to commercial real estate, is more transparency and also really understanding what the data is. I know CoStar is the monster in the room, and it's really interesting since they get their information, it's like playing telephone tag. And so when we have true data integrity on exactly what's actually happening in the different markets, and it's not just through word of mouth and you don't actually know every single clause and detail that went into it, where let's say the rent was at $120 per square foot, but actually they got 6 months of free rent. So it's not actually quite accurate in how it was portrayed. I think we're about to see a lot of things change and have better pricing and also just a better experience on both sides, both for real estate owners and buyers, sellers, and the people using their product as well.
That's solid. I think maybe View the Space could be the competitor to the behemoth of CoStar, as they're trying to be at least. Something that we talked about before that I took note of, I want to bring it back to. We're talking about the hygiene. We're talking about the transportation, the fears of being on LIR, MTA, the subway system. Is that going to affect your thoughts in investing in a certain location? As you know, maybe there's a flight back to suburbia and the densification of New York City, and like, I'm scared to go back to work. I don't know. You know, talk about that a little bit. I see Phil, you know, pretty excited about this, so I'll give it to Phil.
No, I just think it's really an excellent question. It's not that I have any particular type of thoughts that I've thought about prior to you just bringing it up now, but I'm just thinking about, look, people were worried about social distancing. Then next thing you know, there's protests and people are traveling in flocks, totally disregarding that. So I think that basic desire to do whatever to help people, the basic desire to have convenience will override any type of danger that I think people feel. At some point, people are going to need to be out, I think. But I think it's an excellent point. Maybe it has marked a shift to where people would flock out there. So I really don't know. I'm just excited to hear what other people think.
Sorry, you're my type of cynic. So I'm contrarian here, right? So I still remember ages and ages ago when I was working for a family office and we were meeting with this private equity fund out in Connecticut, of all places. And I'm asking, we just talk about the long-term trends. And he's like, I would short the suburbs in a heartbeat. None of my kids want to live in these McMansions in the burbs. They all want to be in the city. It's more fun. There's more opportunities socially and for work. It's cleaner than it's ever been. It's safer than it's ever been. You know, all, you know, current events perhaps notwithstanding. But in general, there's been a very strong long-term trend to coming back into the city. Now, I do know some people, especially my peer group, they're like, I know it's time for me to move out of the city. Some may actually do that, but I think it's going to be, at the end of the day, I think it's going to be a blip. And especially if we get a vaccine, it's going to be like, okay, we're good for the next 100 years. Let's go back to being oblivious.
I agree.
A lot of opportunities. Sure, you're probably seeing the opportunities right now.
Yeah, I mean, I think we're right. It's sort of reaction versus like having it really is reaction right now, where you hear these stories where people are trying to move to the suburbs. They're like, okay, I'm really tired of being stuck in my 1,200, 800 or 1,200 foot apartment. Like, I'm just ready to be done. Let me go have a backyard so I can get rid of the family and like have some personal space and go on a walk. I do think, I mean, regardless of COVID, we have relatively short memories when it comes to let's look at the financial crisis of 2008. And also, I mean, we've had a lot of financial crises, and yet history repeats itself. I do think that New York will stay strong. I do think, though, in the immediate future, you will see, especially for multifamily owners right now, I think next year will be a little bit difficult, and I think they will take a haircut on what they were charging in rent. But I do think it will come back stronger than ever. And I think, actually, personally, New York needs more affordable housing. And that's an issue that actually one of my mentors and good friends, Alicia Glenn, former deputy mayor of New York, also shares that same sentiment. Is we'll actually continue to see growth. I think the next 12 to 24 months may be slightly different than what was expected come the end of 2019, but full faith that we'll be back to normal at some point in time.
So Charlie, where I think we'll see the long-term effects actually lingering isn't so much into, where are people moving, but it's going to be how we do business, right? Especially where it was, I think both Drew and Philip made this point at different points in different ways. There are processes that stay the same way they are because they've worked kind of well enough for a long time. And unless the people involved are forced to change it, either by harsh economic realities or by customer demand, they're just going to keep doing it on momentum. Well, like COVID is a forcing function for a lot of them, right? They got to be able to work from home. Well, I don't know. How do I keep the file secure? Or will my employees be productive? Dude, you have no choice, right? Figure it out. It's inconceivable that in 6 months after it's working, that same person's going to go back and say, well, it worked well for 6 months, but now it can't possibly work. We have to can't work from home anymore, right? Or it's like distance medicine, right? There's no way we can figure out the billing. There's no way we can figure out the privacy. Well, I guess we just did it for 6 months and the world didn't collapse, at least not from that. But now all of a sudden the crisis has passed. We got to go back to the old inefficient ways. Also, that's totally implausible. So where the crisis has forced us or my startup's customers to get comfortable with something that they were resisting, once you are comfortable, the comfort doesn't go away. So that's going to be, I think, the permanent legacy of this crisis.
That's good. Let's talk about a little bit. We have a couple more topics to talk about, so I definitely want to encourage people to start submitting questions that Mike will bring up in a little bit. But winners and losers, some predictions that you guys have, what's going on. On my end, you see right now, retail is losing, but that could be a blip. I mean, the winners right now, the industrial market, the Amazons, they're absolutely crushing it. And the office, I think, is just kind of putting away from what we see. Anyone who's trying to make a deal is pushing out that decision probably to the end of the year. Yeah, we can work from home for the rest of the summer. At the end of Labor Day, I think, we'll try to figure it out then. But winners and losers, either sectors, really, I'll let you kind of go wherever you want, but give me some predictions. Phil. You're on mute, Phil.
My apologies. In
Okay.
terms of retail becoming a blip and office, look, that whole working from home thing, a lot of people resisted it. It was almost as if you think of Amazon in the year 2000, people were apprehensive about putting their credit cards online unless it was safe. Until they realized
putting her credit card online.
Now it's something, the whole, now there's digital currencies, peer-to-peer, all this stuff, you exchange money through your phone, it's become normalized. I think there was a similar type of apprehension from old school bosses and employers about people working from home. Now they're seeing, I think people are seeing, I'm not sure how everyone else's productivity is going, but people are seeing that it's because out of necessity, you have to. I think people are seeing that it can't be done. So obviously office is going to suffer from that. People have been shopping online for the longest, and the malls were already suffering. They were trying to integrate and incorporate experience into the whole thing, movie theaters, theme parks, just to get people there to do fun stuff and then shop around, while they're there. I think there's a mall, and this is already happening. Mall REITs are bleeding like stuck pigs. So I think you're going to see a lot of permanent change in how people shop, that whole, like the retail sector and the office sector. I do think, I will say this, a lot of the office REITs around New York City, those are such great assets backed by such deep pockets. They'll figure out a way to reposition it. Because these are smart people. And if they're not smart, they have deep pockets and they can find smart people. They'll figure out something to do because these are still trophy assets that you have to pay a premium to get anyway. They'll figure it out somehow, whether if it's for residential or some sort of hybrid co-living, co-work, I don't know. But I think those two are going to suffer dramatically. I even think there's going to be a shift in whether people are going to flock to suburbia. I don't have any opinions on that really. I do think people like the urban living, people coming together. I think you're going to see a lot more co-living setups. You see people that are making $250,000 a year that want to live with a roommate. Before, living with a roommate was something you did out of necessity. But you see just like you see big brands going to co-working and WeWork before it sort of like, became before all this happened. You'll see the same thing with investment grade tenants. But on the personal equivalent of that, like basically someone who makes a lot of money, wanted to live with others. I think you're going to start to see more of that. But this is just based on indicators I'm seeing now. So that's my, but retail and office, I don't know, man.
Drew, let's flip it over to you. How about you some predictions, some winners and losers?
Well, I think retail was already struggling, and COVID didn't help, sort of hit it over the head one more time. So I think that's an easy one always to bash. I do think, though, sort of as you were saying, industrial data centers, sort of these digital infrastructure projects are on the rise. And so from a cap rate perspective and actually a hard desire from even the institutional players, they're absolutely there. I would say on the office and even the multifamily and sort of the new developments that are coming through, it's more geographically impacted, where we've even seen sort of some of the markets that opened before New York and before LA actually started to recover more quickly. Leases actually started to be re-engaged and actually were beginning to be signed. So I think it really will play out really more on a geographic basis. And it's really too early to tell who is going to be the winner and who is going to be the loser. But to sort of mimic and sort of repeat what Phil was saying is the people who have deep pockets and who can withstand the drawdown will be the best positioned, both to play defense and then offense also at the same time.
Andrew?
So listen, Charlie, you, Drew, and Philip, you're far more qualified to talk about the actual real estate of the real estate sector. I only know the tech side, and even that, some people would argue against. But I will, talking on the technology side, some of the winners right now, we've talked about anything that's doing remote viewing, both on commercial, residential is hot, even remote visualization. We've got a couple of bets in that space. Things that are doing access controls, especially where they have a sanitation element, they're going to be big winners. Some of the less obvious winners, tenant amenities. So especially on the residential side. So we have a portfolio company called Amenify, and it's all about helping the tenants in your multifamily property get cleaners to come in, get dog walkers. It's all within the property's own app and services. So, before it was nice to have, it was good, it helped increase rents. It was cheaper than putting in, say, a gym, and people used it more. But now with people working from home that much more, having the services come to them is that much more important. In a way, it's kind of like, it's the high ground, right? Before I go out to shop, I'm already in my home. So if you can get closer to that purchase decision, that's a winner. So companies like that are one of some of the less immediate winners. We've got companies out there that are in the co-working space. I still think co-working in general is a real estate business, not a real estate tech business. However, there are companies out there that are playing the marketplace. So instead of me owning a vacation property, you could be Airbnb. We see companies in that area around co-working, and in particular, there's one, this is probably a great example, one of the companies that could not have been hurt harder in the short term by COVID, but in the long run, the future is as rosy as possible. So what these guys do, the company's called Kettle Space, they will take underutilized hotel and restaurant space, turn it into co-working spaces during their downtime, right? Basically most of the day except for dinner, or every day the hotel doesn't have an event. So there are huge cost advantaged over traditional co-working because they don't own any assets. Great company, doing really well coming into February, went down to 0 revenue in March, shocking. But in the long run, as the heads of real estate and the heads of HR are trying to figure out how do we return to work, right? How do we deal with the reluctant workers? How do we deal with the phased returns? They're all looking for spaces that can be spun up and spun down fairly quickly that are near their employees. And like companies like Kettlespace can move really quickly to take advantage of that. So those are some of the more subtle long-term winners in this game. There are a lot of companies out there that in general, I think it's kind of a push. So we have a couple of smart apartment startups in our portfolio. I think the future is still going to be good for them. But I think in the short term, it's been harder for them to make sales because everyone's attention was on like, can I collect rent? And those few technologies that help me collect rent or actually continue to do business. So it's just a factor of not being able to get the right decision makers' attention right now. As that passes, and that'll pass even before the crisis passes, it'll be a factor of like, okay, I've done all that I can do to deal with the now, and now I'm going back to kind of a semi-normal routine. Like as that happens, the startups can now start getting the decision makers' attention again. So for a lot of those startups, it's kind of just, you got a couple of months that are going to be a little slower that you just have to get through. And then there are a few like the co-working spaces. And Philip, I disagree with you on this one. On the co-living, I personally would have been a co-living customer had that happened 20 years ago. I like living with people. I think there's going to be some negative headwinds on that one because now all of a sudden I'm not just living with someone, I'm sharing germs with them. And I think that I might still want to live in the city because hey, the city's awesome, but maybe I don't want to kind of share a germ phobe. I don't know if that's a word, a germ bubble with people I don't have to. But I don't have a bet in that. So, we'll see how it plays out.
Yeah, I think the opposite is probably the micro apartment approach that you see. Maybe that's the move. Kind of switching gears before we get to the Q&A process. I want to just understand for the community that's on here right now, the opportunities that you're working on and that you're looking for that you could be possibly open to. If somebody had that opportunity, they could possibly approach you, email you or something like that. But this is more of the collaboration aspect of this. What opportunities are you working on and looking for that you'd be open to having that discussion? So Drew, why don't you start it off?
Well, so while we were on this, I already sent a direct message to Phil to connect right after this. But sort of what we do across the board is work with real estate owners, both from developers to private equity firms to REITs, both public and private, to family offices, and then also on the financial institution side, everywhere from sort of retail customer bases to self-directed like IRA accounts, wealth advisors, the big institutions and pension funds. So we sort of touch a lot of different spaces. And it really is also getting exposure and just education on the product itself. And I think that's really what we're focused on, especially at this point.
Cool.
I know it's a wide base, but it sort of covers, when you have two-sided market plus a technical infrastructure, a few things come into play.
That's good. Phil, how about yourself?
All right. So fundamentally, from a deal-making perspective, I like to stay pragmatic and obviously grow and scale at a pace with that is appropriate for millennial, but at the same time conservatively and intelligently. So one of the ways we do that is that we stick to what we know, and I don't jump into something from if it's always sequential growth intelligently. So it's not like into a totally new different field because you don't know what you don't know, and there's always a tuition tax, as I call it. However, one of the things that I see as a tremendous growth opportunity is to GP less deals and scale by going into new markets with seasoned operators. And we're testing that in Brooklyn, as a matter of fact, because I know Brooklyn well, but the things that I don't know well, and the people underestimate that, the construction cost per square foot, the rental loss that exists in New York. I'm in Jersey City, where it's different. It's far more tenant friendly here. How do you increase the cost per, the the rent that you can get per square foot, because that's the game. Co-living, just like you mentioned, micro units is a play. Don't know where that's going to go, but I do see that as a potential play. But the co-living, that's a way that you can increase, say, from 4 per square foot to 6. You see that all over. You see that all over New York. So in terms of how that can help us in what type of deals that we want to do, we want to do deals with people in the right type of submarkets throughout the country, in the right asset classes that I understand. But the blind spot I don't have is the local knowledge. So the guys who have the boots on the ground and that have a system. So I'm not betting on an idea. I'm betting on a system that I can reasonably predict if it can scale. And there's only something like this that would actually knock me off course. That's just an investment thesis that I'm comfortable with. And because of the app that we have and the community that we're amassing capital, sheer numbers, a community that will only grow. And for that, we have something like a lot of times people in private equity, whether it's VC or private equity real estate, someone has the capacity, someone has the capital. You bring the two together, you have a lovely marriage till death do us part, hopefully, right? Instead, the people who have the capacity, maybe not the capital, those are the ones we want to team up with. But instead of being an LP, being a co-GP, maybe not ask for carried interest, which is really just the bonus you get for doing the project successfully. I know Andrew will know what that's about, but that's some of the opportunities that we would look for. Local operators at the right size at the right time. It's something that we can incorporate into our platform, and that's something that I would look for.
If you need that market information, let me know. Cushman & Wakefield's a pretty big company. We got boots on the ground all over the place. So it's office rents or anything else. Let me know. I got you, Phil.
All right. Thank you, Charlie.
That's what I'm here for. All right.
Yes.
Andrew, how about yourself?
Sure. Yeah. Again, in my weird little world, I've got different needs. So sure. I need two things, right? And I'm totally open. Anyone who's got them or has any questions, feel free to email me. It's andrew@dreamit.com. I answer all my emails eventually. Just do me a favor and be very clear on the subject line. Entre, Zoom follow-up, want to discuss X, so at least I know what it is. So the two things that I need, great startups to invest in. So we're looking for startups that are, not cocktail napkins. They got to have product, some traction, preferably revenue, enough that we have a good feeling that they've got something the market's actually willing to use and pay for. So that's number one. If you got anything in prop tech or construction tech, I'm your man. Shoot them over. And number two, we're always looking for potential customers for our startups. So please, if you're an operator, a developer, a property manager, and you're looking for the kind of technology that can give you an edge, or at least keep you from falling behind, reach out to me. Give me a wish list. Say, I'm looking for these three things, right? What do you recommend in those spaces? And even if they're not a company that I'm invested in, I see about 2,000 plus startups a year. I kid you not. I've probably seen something that's relevant. So feel free to just, send me a wish list. I wish I could have startups that solve these three problems, and I'll do the best I can.
That's solid. And, I'll throw my hat in the ring here too. If anybody needs office space, I'm your guy. I'll take care of you. And Andrew, I represent also landlords and leasing that space. So when we do,
we didn't talk about tenant rep. We need to talk about that.
We can talk about it all, but if we need to, get you in on the pitch to show the landlords how they can amenify their buildings and make them better, I'll reach out to you guys as well. Mike, we're going to do the Q&A.
I'm on that show too if you want me. Don't worry about it.
Listen, we'll do it all. Taking over the world, right, Phil? I'm sure he's got that. All right, Mike, you Q&A aspect of this. I saw some comments coming in here. Why don't you take over a little bit and throw out some of the questions?
Yeah, I've been getting a bunch of private messages here about questions. This has been awesome. I've been loving this though. You guys are getting into some very interesting topics here. One that we had a question come in, I think it was the first or second question. It relates to what Phil kind of just mentioned briefly with the different asset classes. Have you guys seen anything, or with COVID, certain asset classes are getting affected more than others? Types of properties, residential or commercial, are getting affected more than others? What have you guys noticed within the different kind of classes, as luxury to Section 8 or BC classes, and vice versa?
Well, I can jump in. I was just sitting back, but in terms of luxury, those are the people that have money, so they're pretty well positioned to weather the storm. If you look at some of the statistics, you'll see that a lot of the fears. I think a lot of people are doing the right thing uh, by paying, even if they can. A lot of people are not taking advantage of the loophole, if you will. And I don't personally have Section 8 tenants, but I do see if there's government assistance, that would be at least from the standpoint of making sure you get your rent. That could be interesting. And then the luxuries, the people who do have the money, it's the in between I don't really know about. And with the existing tenant pool, we're basically the people who live paycheck to paycheck. Essentially, I think that can be a risky game. But at the same time, strip aside the whole rent forgiveness, or what it's called. Just think about it. People are being inside. That's really just heightens the need for shelter, and not just shelter, whatever operates within. Like, because right now I'm at home, I had to set up a home office. I had no choice, so I had to figure out a way to make it comfortable. Kind of like yours is sweet, Mike, but wherever you are. But if this was a home, that would be sweet. I wish I could have something like that. So stuff like that.
I'm in Pittsburgh. I wish I was in New York, but this is our office. Yeah.
Okay, well, that is not home. But anyways, you get what I'm saying.
It's a co-working space, though. We don't own it. Yeah.
but it's, so that's what I'll see is as people are being pushed to be more at home, and I don't really know where that's going to go, but I do see some interesting movements there. So, but in terms of, to answer your question, it's the high level, the people that have money, that should be okay. And then the Section 8, where they get the money to make sure that they pay. I think that is an interesting thesis anyway. I wouldn't know firsthand, so this is just me speculating, but it does seem interesting from the standpoint of making sure you get your rent.
Drew or Andrew, you guys want to add on the classes real quick?
I mean,
Drew,
Andrew, go ahead.
Okay, I'll just bring something we haven't talked about before, and I'm going to give credit where credit is due. I get this from my wife. She's a broker at Compass. So on the residential side, they're only seeing price concessions in like the 5% range, maybe a little higher. And I should qualify that by saying that she does sales, not rentals. Like, the rental guys are hustling hard, and people are getting really great deals if you can commit to a lease now. My thesis with her is that if you're looking for a 3-bedroom apartment or bigger in Manhattan, you're already looking at close to $2 million or way above. You're going to get some deals, right? If you're looking to upgrade, right? You have 2 kids, you just have a third. You're going to sell one apartment, maybe a 2-bedroom, buy a 3-bedroom. What you lose on one, you're going to more than gain it on the other. But a lot of people just are sitting it out, right? I mean, the volumes are really low. So it's weird. Like, you would expect in this kind of market to be a massive drop, right? Like, who can sell now? People just taking the market off. And that's the thing with residential real estate. Your alternative is to just live in it a little longer. So I don't think it's going to have the same kind of whiplash maybe that might happen in the commercial. Grain of salt, though. Like, I know the tech side. You guys, if you have a different opinion, you probably know best.
I'm just also, Phil, you hit the topic sort of first, and I actually fundamentally agree. So what we've seen is in Class A office, these companies do have the ability to pay. They will pay. And sort of the same thing, even with Section 8 housing. Think about who the fundamental underlying tenant really is and who is the guarantor and who's paying for it. So it really is credit rating. Retail, on the other hand, you're even seeing Staples, who has the cash, but they're waiting on paying. They are not, and there are a number of other large companies who technically do have the ability to pay, but it's actually more sort of asset class specific, where you're seeing payments being made and payments aren't. I do think the multifamily will, sort of what I touched on before, will soften, especially on their pricing. And so pro formas will not be hit, especially this year, especially in the multifamily space, since you did have a slight exodus and people are a little bit more hesitant to be in the city until we have a vaccine. So that's something just to be aware of for the more immediate future. But otherwise, there's still a whole bunch of unknown, and for most of it, we're going to find out. It's not something we can know right now. And in the next 6, 12, 18 months, that's when we'll actually have data. Since right now we're speculating and we're just working almost week to week on what we're hearing. But for the long term, it's to be determined.
I could jump in here too, Mike, a little bit. What I'm seeing on the office side is landlords are getting an overwhelming amount of tenants looking for concessions. And what they have to do basically is overlook everybody's case, essentially. And there's a lot of cases to be had. So I think they're spending their time looking at the retail, trying to help those retail tenants out first, probably with rent deferment, pushing that out, moving the term a little bit longer. On the office side, if you're a lawyer, you can work from home. They don't really care about you. It's not going to be that much harder, at least from the conversations I'm seeing. But I'm working with a physical therapist who's in an office space, and his company is just like a retail. You're getting traffic in and out, so he's going to be a little bit more lenient on him and possibly give him a month or two free, or defer the rental payment for a month or two at a time and push it back to the end of the term, and then reevaluate it after 60 days, 30 days, or something like that. Back to you, Mike. You're on mute.
Sorry, I got a bunch of different things going on. No, that was great. I think you guys are spot on with this. We had another question here too. I think this pertains probably mostly to Phil, but the others can jump in if they want as well. We had a question here. They're asking if they're interested in getting into investing, how long should they maybe live in a city to understand it, or how long should they learn the different ins and outs of a city? Because obviously real estate, it is tricky. Every city is unique in its own sense. And there's different ways of going about it, right? You could just have an operator in, a market that understands it and whatnot. If someone's looking to kind of buy real estate themselves or whatnot, Phil, do you recommend people live there, understand their market before they would get into real estate or buy that? Or does it just depend? If you can find a good opportunity and a good investment, doesn't matter where it's at, you jump on that.
Well, what I would say is it really depends on what type of investor you want to be or where you see yourself going over time. If you're someone who's just looking to be essentially a retail investor, looking to build essentially middle class retail investor, I'm not saying this in a disparaging way, with someone who was a good job and is looking to build some assets, a good way I would say is to probably go the LP route, basically invest with another landlord that knows what they're doing. They know they're in the trenches. But if you're someone who has aspirations of being a professional landlord, I always recommend you start with a smaller property and using an FHA mortgage, simply because it's very little capital upfront, and you have to live there. So what that does is it removes the biggest overhead driver of your personal life, which is rent. And then you get to learn psychologically and emotionally what it's like to have tenants, to operate a building, to pay the property taxes, to have a mortgage, all those things that come with it. So it's tremendous training. And then you can find out, is this real estate investing game for me? Am I cut out to be a professional landlord? And from there, you can scale accordingly. This is the route that I took. If you're someone who just wants to get into the real estate asset class, there's a number of ways you can do it, with REITs, with private REITs, with there's a number of crowdfunding platforms. There's if you're a little more serious, if you have a little more dough, you can go into something like CrowdStreet, where it has LP shares that they basically offer to in hotels and garden style apartment complexes and things of that nature. You get to learn it from the standpoint of theory, really. You're not in the trenches, but you get to see what's happening. And then you can sort of see what direction you want to go in from there. But the lowest barriers to entry would be buy, what is it, $7, you own a piece of the Empire State Building. So, but it's a really tough question to answer, because it's not quite as simple as it's presented in terms of, do I just know the market? I mean, if it's a place that is, I look at a couple of things: proximity to the action, meaning downtown, and not only that, is it close to retail, and is there transportation? So those are the things. Once you have those things, you can sort of dive in deeper from there. And you got to look at the numbers, of course. But I would say a small multifamily, 3 to 4 units, FHA loan get to live for free while you figure out what it's like. And then if you figure out if it's something for you, then go for it. If not, I would just like buy REITs and diversify different asset classes, real estate being one of them. Those are sort of my thoughts.
Anybody else want to chime in or go to move on? All right.
I got nothing. Not on this one.
Yeah, we're good. We're good. No, I appreciate that. All right. So we have another question here about long-term impact versus temporary impact with COVID. I know we've talked about this a little bit, but if you guys want to dive into it a little bit deeper, do you think there are any like real dangers for metro office space for these, you know, highly condensed cities in the long term with this? Or do you think this is really just a temporary thing? And once there is a vaccine, once there is that, obviously there's some uncertainty, but you know, no one's a wizard here and can predict the future. But do you think that this is something that, you know, people will eventually go back to cities? Or do you think that, you know, because I know, Andrew, you mentioned the shift was going into big cities, right? And do you see that still going, you know, forward once all this is over? Drew, I'd love to hear your thoughts on this as well, and Phil too.
I haven't changed my mind in the past 15 minutes, so I'm going to stick with my prior answer.
All right, fantastic.
I think you'll see some slight changes in the immediate future. I do think the human psyche and just psychology is we sort of forget quickly. And so, especially if we do have a vaccine, life will go back to normal. I do think people will reprioritize what's important to them. And especially, I don't think office is going away. I do think the ability to work from home certain days, so you may be in the office less, may actually push sort of the everyday person to look for a slightly larger apartment, maybe be willing to commute further out of the city because they're only going to commute 3 or 4 days a week. And so those would be the impacts that really come into play. But from a fundamentals perspective, in the long term, it'll stay relatively the same. And if anything, we may just see a little bit of further urban sprawl.
Gotcha. Okay, great.
I'll jump in real quick, Mike.
Sorry. Yeah, go ahead.
Yeah, I think it's mostly for the office side. It's the layout of how you're going to work. You know, I'm working with a company right now that's in an office space of 5,000 square feet, and they're actually growing. They're a real estate investment company. And they need probably double the offices, but we're going to take more than double the space because the bullpen, again, is going to have to expand. You need to be cognizant of the people around you and whether that's going to be, you know, putting those large bullpens with the shields up or whatever it may be, arrows around the office so that everybody is not congested in one area. But you're going to see more of the workplace solution aspect of this coming in and how to efficiently work in your office without, you know, affecting others or getting others sick.
Yeah. Gotcha. So jumping into, we have another question here. It was brought up briefly, I believe, with the micro units and stuff like that. Kind of similar question, but more towards residential. We have someone who asked about tiny homes, micro unit real estate. Have you guys heard? I mean, obviously, the tiny homes it's kind of been a trend over the last few years, but have you guys seen anything with this recently, with all this going on? And what are your thoughts in general on kind of the micro tiny home kind of thing?
So I haven't seen anything over the past 2 months that's radically different here. I think it's going to take longer for that to trickle into the market. But I've seen some really interesting stuff in the space over the years. There was a company that we looked at very closely a few years ago called Bumblebee Spaces. And what they were making units that would drop from the ceiling. So a bed would come down, a couch would come down, a table would come down. So you could take the same 250 square feet and get 750 square feet of usable space because it was all flexible, right? It's a really kind of gee whiz thing. We've seen other solutions on that where you have kind of, I don't know, bed units that would slide. It's basically a Murphy bed on steroids approach. Anyone living in the city is already trading space for distance. So the tiny home, tiny apartment movement is just taking that to the extreme. And anything that makes that tiny space feel a little less tiny. It's gonna, sorry, I was gonna say it's gonna find a home in New York, but that's already a bit too much of a pun.
Andrew, that's an excellent point. One of the things that I've seen, if I can chime in here, there's a project that just hit the market by Journal Square in Jersey City, which is the main area. It's one of the submarkets of New York City Metro, where there's a lot of growth, a lot of development. You see micro units there, and to your point, the challenge in a market like New York City, where the rent always goes up and goes up, and it's sort of it's outpacing inflation, and there's always going to be a correction for whatever reason, just to make sure that the levels are stable to some degree. So the challenge for real estate operators figure out, how can I hack the rents per square foot, right? And so they resort to, and again, the co-living, adding amenities that can justify a higher price point. That whole setup that you said is very creative, because ultimately the value of your property is derived from what it is you get per square foot, well, which you can charge in rent, right? Which comes down to a per square foot basis. So micro units are popular for underwriters for that very reason. But what I will say this, and this could be a cautionary tale, I saw 3 years ago that one of those operators that had to give up a really good portfolio for pennies on the dollar, they were buying properties all around Manhattan. They had a lot of retail investors from South America, wealthy people from there that wanted to put it into New York City real estate. So they would buy buildings at a 1 cap, meaning at a 1% cap rate, which isn't sustainable because it's well below your cost of capital, so you're losing money. But they did that because in their performance, they were seeing what was happening with Airbnb and WeWork. So they created an Airbnb replica and a WeWork replica without being either. So sure enough, the regulations hit Airbnb, so those assets suffered. And then the whole thing with co-working not being as mature an industry as everyone initially anticipated, and with the whole thing that happened with WeWork, all the bad press, that hurt them also. They were not able to meet those performers. So I'm seeing some of that in terms of micro units. I don't know if it will stick. It may. I do think co-living has a space. Micro units, it remains to be seen, because it's something that's relatively new, and we don't know for a few years whether it's something that's sustainable. But if it turns out to be, you start to see a lot more people go that route, because whenever you can increase the price, people go that direction.
So one of the things we didn't talk about, that's one of the interesting trends here, is kind of creating almost a flexible utilization of a building, right? So there's a thesis out there, and I subscribe to it to a certain point, where any building you could flex up and down between traditional kind of empty, unfurnished apartment rentals to furnished, to co-living, to short stay.
Sure.
And you've already seen some companies like the Saunders and the Domi of the world come in, and they'll manage like a whole floor as an Airbnb within a multifamily. So the more forward-thinking operators have been, and landlords have been kind of exploring almost the ability to flex up and down the percentage of a particular building that is allocated to any one particular type of inventory, which in normal times would be very useful. Like if COVID had really only decimated the travel industry, and like no one was using Airbnb style apartments anymore, they could repurpose those as furnished apartment rentals, or vice versa. So I do see that happening, and to the extent that you could maybe combine and separate apartments, right? Hey, they could be 3 micro apartments in a co-living arrangement, or they could be short stay, because you don't need a full kitchen in a short stay. There might be something in there, but we're still really, really at the early stages there. And we're constrained by like things that you never even think of if you aren't in the industry. So for instance, like if I want to refinance my building, the underwriter is looking at my lease qualities, and if I have more than 10% of my leases that are short-term, like month-to-month Airbnb or day-to-day Airbnb stuff, that might affect my ability to finance the building. So things like that are changing slowly, but I think there's maybe a long-term trend in that direction that'll play out probably over decades rather than over years.
Sure, you want to add anything, or are you good?
No, I agree with Andrew, where it will be over decades and not in the immediate future.
Mm-hmm.
If anything, after being cooped up in my own apartment for the last 12 to 13, 14 weeks, definitely not going smaller. Also seeing a number of the people who were in small apartments were the first ones to exit. And there is a quality of living, especially if we do see the change in the work from home and then going to an office space and that dynamic change, I think we are very, very, very far away from seeing that become the new normal and the new standard. And I don't see it anytime in the next 5 years.
Yeah, you almost see it as a reverse for the short term because people want more space.
Yeah,
everything going on, and then maybe switching back. Interesting. Okay, cool.
exactly.
So I know we're coming up on time here, so this will be our last question, and then we'll wrap up with Charlie, and everyone can give their final thoughts. This is an interesting topic. I don't know how familiar you guys are with this. I think that it probably relates mostly to Andrew, but there's a lot of talk about, obviously technology integrating with real estate, and now we have 5G coming into play. So Andrew, I don't know how much you've seen with this, with 5G being integrated now into buildings, into homes, into commercial office space. I don't know, Charlie, if you've seen this too, and how that might affect not only, kind of how people are working, but in their office, but then also just like how business is being done.
So actually, ironically, I think the other panelists will be able to talk to it a little better than I am, because truthfully, I see 5G as an incremental improvement. I mean, it's much, much faster, but it's not like I had dial-up and then I went to cable or something much faster. It's not like I didn't have a mobile phone where all the world's information is right here the second I want it, and now I do. Those change things radically. Upgrading your building to be wired more effectively, more efficiently is kind of a normal upgrade in my books. I've seen some interesting startups that have been playing in that space, and they've been using it to kind of change the model where, like, they'll go in there, they'll wire your building for nothing, and then they'll take, the contracts. Those are interesting financial models. But at the end of the day, I think the decision to upgrade is going to be purely, I think, Philip, you brought it up, it's, if I upgrade, what does that do to my rent per square foot, right? It comes right down to that basic calculation. I don't think it fundamentally changes how I live. I don't think it fundamentally changes how I work. But hey, what do I know?
I love how humble you are. You're like, you've been in the game for so long. It's awesome.
Which means I've been wrong long enough.
That there is a caveat. It's funny, the smarter and more the humbler you get, it seems like. Drew, Phil, you guys want to add anything on that? And there was kind of a second part to this person's question too, about the digital wellness aspect of all of this, like the 5G and like it just being a part of everything, and servers increasing their frequencies, all of this stuff too, and how that might affect people's like living situations and working situations on top of that. But Drew, Charlie, Phil, have you guys seen anything in regards to 5G in real estate?
I don't. I haven't seen much. I've heard about 5G stuff. I don't have. It would just be an opinion, so I wouldn't have anything substantial to add. So I'll stay out.
Yeah.
I got nothing either. 5G, I only hear about the conspiracy theories, which I'm all about. Big conspiracy theorist, but
about birds dying from 5G. That's what I heard.
It's bad. I don't know. It's bad news. It's good news. Who knows?
Right.
It's good for the tinfoil hat makers. Like, they're going to sell a lot more tinfoil hats when 5G comes out.
Sell me one.
Netflix will do a documentary on it in a couple of weeks. Drew, do you have you heard
the Tiger King? No. I share the same sentiment. I think it has not been a large focus for any of the real estate owners we've been dealing with. I think it'll have to come out more commercially before it is implemented, especially in the real estate space.
I will say where the wellness is coming in on the commercial side, where we haven't talked about, is air quality sensors and that. So there's been a lot of startups that I've seen over the years, and usually they have some combination of energy efficiency, comfort, and air quality. And it's usually been sold in that order, right? The energy efficiency is the big seller without impacting, comfort. That's been kind of the boundary. Like, we're going to do it without making the place worse. And then, at the end, oh, by the way, like we'll also be able to tell you if there's too much CO2 buildup or if the air is not circulating. I've seen those companies move their emphasis around pretty dramatically and actually start getting some customer interest by leading with the air censoring, the quality there. So that's interesting, and that's all on the commercial side. I'm not seeing that on the residential side yet.
I think Delos is a really cool company to check out. Leonardo DiCaprio is one of those investors, but Delos is that well sensory, lights change when the clouds come by, air purification, and Atmos Air too. Two of those companies are definitely standing out.
I've heard Leonardo pumps pure oxygen into his house. So maybe that's why he's an investor.
I'll let you know next time I go there.
Next time you hang out with him, let me know what he says.
Absolutely.
All right. Before we wrap up, I'm going to post some polls as we're getting into the final thoughts here and everything as well. We're going to get into some breakout sessions if anyone wants to stick around, meet some of the other attendees and do some networking. Before we go, Charlie, you guys want to wrap up? Anything, where can people find you? Where should they follow you if you're going to be putting out content? I know, Andrew, you're posting some great stuff out there. And we'll kind of leave it at that. Yeah.
Check out charlienyc.com. It has a lot of the interviews that we're doing with Entre, venture capitalists, CEOs, and founders of companies of 50 plus employees. Just understanding what they do, they operate, and how we can collaborate with them. That's what we're doing. And we have podcasts too. So if you want to listen to it, check it out. That's all I got. And I'll leave it off to everybody else to kind of, where they can find you. Somebody want to jump in, Phil?
Well, you guys can follow me on Instagram. That's pretty much a funnel for whatever you need to know about me. And so just go there. It's YFWTB. It stands for, it's just an acronym for You're Financing with the Best. So it's not really what it stands for, but that's it. YFWTB.
There you are. You do live streams and stuff all the time there.
Yes. So really just any information, I share stuff about how to get started with investing and hopefully it adds value. So if there's anything, then come check that out and hit me up. I respond as much as humanly possible. So check that out. And anything that we do that we're working on, you can check it out there. And I hope this was of help and value to people. I really enjoyed it. Thank you. I would take this opportunity to say thank you, Mike and Charlie, for putting this together, and Drew and Andrew for participating. It was very energetic, very, very helpful. And I hope everybody enjoyed it as much as I did.
Cool. Hey, thanks actually for reminding me. I screwed up my own Twitter handle way in the beginning. Sorry, it's at Andrew Ackerman. You would also find me at Dreamit. And if you want to email me directly, either because you're a startup or you know of a startup that I should be looking at, or because you're looking for solutions to pressing problems that maybe I have a startup that's working on, you can email me directly at andrew@dreamit.com.
Right.
And then probably best way to get me is either by contacting the website lex-markets.com or drew@lex-markets.com. And then LinkedIn is always the tried and true. While I do get bombarded with a bunch of spam, I do usually cull my way through it at some point, and a great way to get connected. So then sort of know each other even from the outset.
All righty. Well, hey, I appreciate all of you being a part of this. Thank you so much for dedicating your time. I hope everyone enjoyed it. And we'll let the panelists go now. So thank you guys so much. Take care. We'll hopefully be able to do a real estate event in person at some point in time in New York or another city. And maybe we can do a round 2 in person with you guys at some point in time. So thank you guys so much for being a part of this.